All right, let's begin this segment in London where my colleague Juliana Olayinka is on standby to tell us what major headlines are making rounds this morning. Good morning, Juliana. It was a hell lot of, stress getting to work today. Good morning.
Good morning, Chimese. Yes, I've been seeing lots of complaints on Twitter, so you're not alone, but thank God you're here with me.
God. Anyway, British bookmaker William Hill has beaten their annual profit forecast, right?
They have beaten their forecast, even though they're still down in their full year results. It's much better than it was in 2018. So they've just published their full year 29 results. It was 2% decline in group revenue to £1.58 billion, which is still a lot of money, especially considering in the UK, the government have had a major crackdown on bookmakers or gambling online sites as they're struggling to deal with the 4 million people that are predicted to be gambling addicts. William Hill last year had to close hundreds of its stores, and also as well the fixed odds betting terminals, where typically you'd be able to go into a bookmaker like William Hill and spend all day and all your money on these machines. The government last year put a £2 limit on that, which has really affected them, and it's affected a lot of their competitors. But the reason why they've made more last year than they did the year before is because they're really boosting their US increase. In the US, sports gambling isn't as highly regulated as it is in the UK, and they're really seeing a surge in sales there. So yes, they have seen a loss, but it was much slimmer than the market had forecast.
And according to data from the latest House Price Index, prices across English cities have risen above pre-financial crisis peaks for the first time since 2007. What's driving that?
Well, this is a big story for the UK housing market, and it has taken 12 years for all English cities to show an increase. So every year, what this survey is showing us is that house prices has risen by 2%, and month on month, it's risen by 0.3%. So in English cities at the moment, the average house price is about £258,000. If you want to live in London, where I am, it will cost you about £450,000. What they're saying is there seems to be a surge in optimism. Consumers are buying again. And believe it or not, it's the supply-demand issue. There's just not enough houses being built in the UK at the moment. And because of that, there's a premium on houses, and of course they're much higher. In London as well, lots of observers here are saying that there seems to be a rush from foreign investors because the pound is so weak. So good analytics from the UK housing market.
Well, Juliana, I have no plans to live in London, at least not yet. Anyway, new research suggests that online learning is helping to boost the UK's economic output. How so?
Yes, this is a really interesting survey by a think tank which have coupled up with Google. They polled about 200,000 people living in the UK. And yes, according to the results, it shows that about a third of people were using free online tools to boost their employability credentials. A lot of people also said that when they're using online videos or online search engines, they were also able to get pay increases within their jobs, purely because this information has been helping them. This is really good for those who are struggling to pay with university fees or any other courses, because now, according to this survey, if you go online and you type a video into YouTube, you type a search into YouTube, you can get a new job. In the UK, if you wanted to apply for a certain position, some of the top searches here are learning how to cook. A lot of women and men, of course, are going online just hours before they have visitors to search just how they can get their culinary dishes upright. DIY skills are also really important, and also coming in third place are gardening tips.
All right, so what is the latest on February's retail sales? Is the UK high street still struggling?
It is still struggling, Chimazi. Of course, last year was the worst year on record for UK retail sales, even though we've tried. We've only imported Black Friday into the UK from America over the past couple of years, but they are still struggling with business rates. According to CBI, and they produce this quarterly survey once a month, they have said that in February, retail sales volumes are going to be at 0%. Now, in December and in January, it was 0.1%. So this decrease is seen as a real big blow, especially as we're coming into the March of the 11th spring budget. We know that 50 of the biggest retailers just last month wrote to the outgoing Chancellor of the Exchequer, Sajid Javid, saying they really need to focus on the business rates, because business rates for some companies are costing more than the rents. And we know that a lot of people were just not going into stores, especially outside of London. People are preferring to go online. And if the UK government does not want to see the death of the high street, they really need to re-strategise and rethink just how they can boost retail numbers in the UK.
All right, thank you, Juliana. I'm sure you'll have more updates for us later in the day. And back here, it's a new trading day. And of course, traders, the equities market are looking out for better deals today. Let's cross over to the exchange for update on today's activities. Stockbroker Andy Sako will be talking to Temple Ashaju. Temple.
Yes, Mr. Thank you so much. So, Mr. Andrasaku, thanks a great deal for joining us this morning to look at the opening call of the stock exchange. Yesterday, we saw some kind of a decline, some 0.03% slide from the key benchmark indices. We are already in the earnings season, in spite of the fact that Zenith Bank, which has released its earnings, is paying out some 2 naira 50 kobo dividend, and of course, Nigerian Breweries has also indicated a payout of over 1 naira. Basically, we saw declines on these two key companies, as well as others like Africa Prudential, that is even paying 70 kobo yesterday. Give us a sense of what's really going on this time.
Yeah, okay. I mean, it's no longer news that we're in the earnings season, and as expected, the companies are actually coming out, with sterling results across counters. A few of them, of course, showing some decline, particularly companies like Nigeria Breweries. But in spite of that, what we see that is positive coming out also from some of these numbers is the fact that the dividend yield is relatively high. And in comparison to some other products out there in the market space, certainly they're not supposed to be doing badly in terms of pricing. What is common space right now is the fact that because sentiments have remained largely weak, the results have not been so invigorating in terms of stimulating the appetite of investors, and therefore we're beginning to see that, yes, these dividend payouts are in the offing, in fact ready to cash, but investors, particularly for want of liquidity and other considerations, are selling down. So plus minus, we're seeing volumes and value generally, tickling southwards. But on return basis, I mean, if your motivation is actually dividend yield, I don't think you have any reason to worry about the market, because with the Zenith at about 19 naira and a 250 payout, that's a yield that is substantially higher than any average return you find, for example, in fixed income products. So you do not perfectly gauge the market. And of course, because people come in with different motivations, sometimes your need for cash, goes beyond your need for profit. And whichever consideration is the higher for you, you're likely to bow to. So that's basically what has happened. As we speak, yes, the market still remains fairly soft, still losing about 3 basis points at this point in time in the market. But I think it's still quite early in the day. I should be looking forward to greater bolstering of effects in terms of numbers that are likely to come out. So dividend yields are, for me, very encouraging for investors.
Because that is something that I expected to actually drive up the price of Nigerian breweries yesterday, which is the company that I want you to even bear your mind on now. Yesterday it was down by more than 2%. Of course, we saw that the Q4 numbers look quite decent. For Q4 last year, which is the festive period, we saw a bit of increase in the price of some of their products like malt and Heineken and all of that. What for you will be the price target for Nigerian breweries now going forward?
Yeah, well, let's start with the numbers. Generally speaking, the fourth quarter for a typical brewery company is likely to give much more.
We might have to take this conversation in another session because we actually really need to go right now. I understand we're running out of time, but thanks a great deal for your thoughts here.
My pleasure.
Chimeze, it's back to you.
All right, thank you very much, Temple, and of course, thank you to Mr. Saku there. And that's a wrap on the program. Thank you for watching. I'm Chimeze Obi Nwawo.